In the spring of 1711, an important meeting was taking place at the Palace of Westminster in London. Members of Parliament were facing a grave financial crisis that directly threatened the future of Britain. Nearly a decade of continuous wars had dealt a heavy blow to the royal treasury. Every new soldier, warship, and expedition further expanded the Crown's debt. Although Britain achieved victories on the battlefield, the cost of these successes was escalating rapidly, leaving the government with a monumental question: how was this massive debt to be managed? An extraordinary proposal was put forward. Rather than attempting to settle state debts individually, the national debt would be restructured through a newly established private enterprise. Creditors would surrender their government bonds to this company in exchange for shares in the corporation. In 1711, this idea was remarkably innovative. Parliament approved the proposal, and later that same year, the South Sea Company was officially incorporated. Even the company's name conjured grand expectations. The term, South Seas, immediately brought to mind visions of America's vast wealth, gold, silver, and sugar. Yet, there was a reality that virtually no one realized: the company's ultimate destiny would not be driven by oceanic commerce, but rather by the massive British public debt it was designed to absorb. Thus began the story of one of history's very first major financial bubbles. To comprehend the founding of the South Sea Company, one must first examine Britain's financial balance sheet. The War of the Spanish Succession, which broke out in 1701, pitted two major European powers against each other. For Britain, this war was not merely about maintaining the European balance of power, but also about securing Atlantic trade routes, overseas colonies, global commercial dominance, and national prestige. Over the course of the 13-year conflict, the army was expanded, new naval vessels were constructed, and the fleet deployed across the globe. These undertakings were immensely costly. Because tax revenues fell short of funding these needs, the government repeatedly resorted to borrowing. It took out loans from merchants, bankers, and wealthy investors in exchange for interest payments. While everything seemed manageable initially, debts grew over time, interest obligations mounted, and a significant portion of the national budget was swallowed up merely servicing interest on past loans. A further complication existed: this debt was not consolidated into a single agreement, but was fragmented across hundreds of individual annuities and bonds issued at different dates and varying interest rates. This complex arrangement inflated administrative costs and rendered overall management increasingly cumbersome. The government needed a solution not just for securing new capital, but for managing existing liabilities efficiently. The South Sea Company was born directly out of this imperative. Its primary purpose was not maritime trade, but consolidating Britain's fragmented debt under one roof. On paper, this scheme appeared mutually beneficial for all parties, yet even the most promising ideas can yield unexpected consequences. The mastermind behind this strategy would soon become the most talked-about figure in all of Britain: John Blunt. John Blunt, a key figure in the company's leadership, did not come from an aristocratic background, nor was he a soldier, naval officer, or prominent colonial merchant. What set him apart was his keen ability to read the intricacies of the financial landscape. In his view, the government's primary issue was not the sheer magnitude of the debt, but its fragmented structure. The state had borrowed from thousands of individual creditors across disparate interest rates. Consequently, managing the debt and maintaining regular interest payments grew harder with each passing year. Blunt's solution was straightforward: investors holding government debt would transfer their bonds to the South Sea Company in exchange for corporate shares. As a result, the state would deal with a single corporate entity rather than hundreds of separate creditors, while the company would collect regular interest payments from the government in return for holding the debt. Evidently, the company's most valuable asset was not a fleet of ships or colonial outposts, but the public debt of Great Britain. It was not merely this steady stream of interest income that enticed investors. The company's name and its promises of future prosperity sparked immense fascination. In 1713, under the Treaty of Utrecht, which ended the War of the Spanish Succession, Britain secured certain commercial privileges in Spanish America. Under an agreement known as the Asiento, the South Sea Company was granted the monopoly to transport enslaved Africans to Spanish colonies, a trade recognized today as one of the darkest chapters in human history, but viewed by investors of that era as a herald of immense profits. Newspapers, coffeehouses, and London's financial circles reverberated with tales of South America's boundless riches, and many became convinced that the company would soon generate staggering returns. The reality, however, was starkly different. Political tensions with Spain, stringent trade restrictions, and operational hurdles meant that the expected profits never materialized. Yet most investors were either unaware of these obstacles or chose to ignore them. Their attention had shifted away from the company's actual revenue to the future price of its shares. In late 1719, Blunt presented an even bolder proposition to the government, to absorb not just the existing obligations, but a far larger portion of the national public debt into the South Sea Company. Following months of debate, the plan was ratified in early 1720. Thousands of bondholders were permitted to convert their government annuities into company shares, while the company would continue collecting regular interest payments from the Treasury. Parliamentary approval instilled profound confidence among investors, many of whom interpreted it as a stamp of state endorsement. Consequently, demand exploded. Shares that traded at roughly £128 in January 1720 began a steady climb toward spring. As prices rose, new investors rushed in. As new buyers arrived, prices soared even higher, triggering one of the most powerful psychological loops in financial history. Investors no longer discussed the company's underlying earnings, but speculated on how many pounds a share would be worth the following month. Company management further fueled demand by allowing shares to be purchased on credit via installment plans rather than requiring upfront cash. Within a short period, it was no longer just professional financiers, but lawyers, physicians, landowners, and ordinary citizens with no prior market experience who spoke of nothing but the South Sea Company. As the surge continued, no one considered it a bubble. After all, in a rising market, voices of doubt are always the last to be heard. By the spring of 1720, South Sea shares had become London's most talked about investment. Exchange Alley was packed at all hours of the day. Coffeehouses ceased to be casual social hubs and transformed into informal trading floors where buying and selling decisions were made. The meteoric rise of the South Sea Company emboldened other entrepreneurs. Joint stock companies began springing up across various sectors, ranging from mining operations and transatlantic trade to novel inventions. While a few represented genuine ventures, many existed solely to exploit investor euphoria. No one bothered to inspect company fundamentals anymore. The only metric that mattered was that share prices kept climbing. Faced with these developments, Parliament acted. In June 1720, it passed the Bubble Act, which imposed severe restrictions on the formation of unchartered joint stock companies. While ostensibly aimed at curbing unchecked corporate speculation, many historians argue the primary intent was to eliminate competitors to the South Sea Company and protect its privileged monopoly. But by then, it was too late. Speculation had taken root not just in corporate entities, but in the minds of the investing public. By summer, shares crested near £1,000, turning many into paper millionaires overnight. Regrettably, as history repeatedly demonstrates, maximum market optimism often precedes the most severe collapses. Among those caught up in this frenzy was one of Britain's most esteemed minds, Sir Isaac Newton. Serving as warden and master of the Royal Mint, Newton was also an experienced investor. Early in the boom, he purchased shares and sold them at a handsome profit, a decision that initially appeared remarkably prudent. However, as the market continued to climb and those around him kept accumulating fortunes, regret set in. Caught up in the prevailing euphoria, Newton re-entered the market near its peak, buying back shares at significantly higher prices. Shortly thereafter, the rally lost momentum and the first wave of selling began. Many investors assumed it was merely a routine correction, but the selling pressure persisted. As prices fell, more investors panicked and sold, rapidly eroding market confidence. Historical records indicate that Newton suffered heavy financial losses on his second investment. While estimates suggest his loss was around £20,000, historians note that the exact figure cannot be definitively verified. What is certain is that Newton incurred a substantial loss, though contrary to popular myth, he did not lose his entire fortune and retained his position at the Royal Mint. The quote attributed to him has become one of the most famous adages in financial history: "I can calculate the motion of heavenly bodies, but not the madness of people. By September 1720, the South Sea Company stock had reached its absolute peak, but the supply of fresh buyers needed to sustain the rally had dried up. When initial sell orders appeared, most investors viewed it as a brief pause, having seen prices fluctuate and rebound before. This time, however, there was no recovery. As selling intensified, prices plummeted. As prices plummeted, panic selling accelerated. Investors who had bought shares on margin were forced to liquidate their holdings to satisfy debt obligations, rapidly draining market liquidity. Hitting £1,000 during the summer, the stock collapsed within weeks, leaving thousands of investors who had thought themselves wealthy in ruin. In Exchange Alley, only one question echoed: how much further can it drop? The collapse shattered trust across the board, shaking confidence in the entire British financial system. Political pressure mounted, leading Parliament to launch a comprehensive investigation in late 1720. Reports revealed that company directors had distributed backhanders and favourable stock allocations to key politicians, and several executives had dumped their personal shares at the peak. John Illaby, the Chancellor of the Exchequer, was stripped of his post and convicted by Parliament. The assets of many directors were confiscated to partially compensate ruined investors. The Bank of England and the East India Company stepped in to help restructure the South Sea Company's financial obligations, and a major portion of the national debt was reorganized, preventing the crisis from escalating into a sovereign default. Though the South Sea Company lost its commercial significance, it continued to play a modest administrative role in managing public debt for many years. But in 1720, its name was etched into history not as a great merchant empire, but as the world's most infamous financial bubble. More than 3 centuries have passed since then. Trading floors have been replaced by computer algorithms, and paper stock certificates by digital ledgers, yet investor psychology remains fundamentally unchanged. Perhaps this is the greatest legacy of the South Sea bubble: even as technology evolves and financial mechanisms advance, human behavior remains remarkably constant. The 1720 South Sea bubble is often recounted merely as a stock market crash. In truth, it stands as one of history's earliest examples of state debt, financial engineering, political maneuvering, and human psychology colliding at a single point. The company's fundamental flaw was not merely making overly optimistic promises. The core problem was that its market valuation became completely detached from its true economic capacity. When expectations outpace reality, prices cease to reflect intrinsic value and instead reflect human hope. And hope alone cannot sustain a market indefinitely. Today, we observe similar behavioral patterns across tech stocks, crypto assets, real estate, and various speculative vehicles. Though the instruments and platforms change, fear and greed remain the twin immutable forces of financial history. The enduring lesson of the South Sea bubble is clear: while an asset's price may skyrocket in the short term, what endures in the long run is always its intrinsic value. What happened in 1720 is not just a tale from the past, it remains a powerful, timeless warning for anyone seeking to understand financial markets. If you enjoyed this video, don't forget to subscribe to Stock Market Historian. We'll continue exploring the stories that have shaped the world's financial history together.